Okay, let's unpack this. We are diving into what feels like a real geopolitical pressure cooker, and it's all happening in one of the world's most critical energy hubs.
Exactly. The research note we've synthesized for you, which just came out for January 2026, it focuses squarely on these mounting anti-government protests in Iran.
Right, so our mission today is really to give you some swift, synthesized clarity on this.
That's the goal. You need an accurate read on the intensity of these protests, what's driving them economically, and I think most critically, what the concrete investment conclusions are for your portfolio.
And the media is, it's already full of speculation, regime change in Tehran.
Yeah.
But this kind of event, it never happens in a vacuum, does it?
Never. And the source material frames this instability against, other recent geopolitical shifts.
Yeah, it mentions the removal of President Maduro in Venezuela.
And also the persistent U.S. pressure around Greenland. It all leads to that one sort of chilling question.
Is Iran next? Is it the next domino to fall?
That is the big market-moving question. But before we get too carried away by headlines, we really have to anchor ourselves in the caveats from the analysis.
Okay.
The first one is operational. The situation on the ground is just incredibly difficult to verify. We're dealing with a reported internet access blackout.
So any information you're getting is what, severely limited?
Severely limited and often, unreliable. So we have to acknowledge that information fog is thick. Any quick conclusion is probably premature.
Right, right.
And the second caveat is historical. I mean, we've seen these explosions of popular anger before in Iran.
The late 2010s, for example.
Exactly. Those past protests were widespread, but they ultimately failed to create any material political change. So we just can't assume this time is definitively different.
That makes that comparison to Venezuela, which was a much cleaner kind of regime change outcome, feel a bit dangerous.
It is dangerous, and this is where the analysis really shines. You need to instantly discard the idea that Iran is just another Venezuela.
Okay, so why? What's the fundamental difference?
Bluntly, Iran's political, military, and economic role, both in the region and internationally, is just far, far greater. Any major shift there would have immediate cascading consequences.
Across energy markets? Security alliances?
Regional trade routes? I mean, this is a fundamentally different class of geopolitical risk.
That completely reframes the whole mission, then. This isn't just about managing risk in one emerging market.
No, this is about hedging global systemic risk.
So let's pivot and look at the foundation of that global importance, which have to be the energy complex. We need to get a handle on Iran's economic fundamentals, especially its role as this massive energy exporter.
Yeah, and when you look at the raw numbers, the scale is just, it's staggering. Iran's proven oil reserves rank third globally.
Third, so that's right behind Saudi Arabia.
Right behind Saudi Arabia. The only other country technically above them on paper is Venezuela, based on that comparative chart we looked at.
And that comparison brings up a really surprising detail, one that's essential for you to understand, especially when we talk about resilience under pressure. Well, Venezuela, despite its huge reserves, its production has just collapsed, right?
Yeah.
Due to sanctions, mismanagement, infrastructure falling apart.
Right. But Iran, this is the key. The analysis confirms that despite facing years of intense international sanctions, Iran has been able to sustain its oil production.
Sustain it how well?
Keeping its output above its longer-term average. They're running this remarkably effective sort of shadow export infrastructure.
Wow. That is a crucial distinction.
Yeah.
It means the regime has basically prioritized its external revenue, keeping the pumps running over its own domestic well-being.
And that brings us directly to the Achilles heel of the regime.
The domestic economy,
Yeah.
which is the trigger for all these protests.
You absolutely cannot separate the political volatility from, kitchen table economics.
Right.
While the state is focused on oil exports, the internal situation for the average person is just brutal.
We hear about inflation everywhere, from London to Lagos. But give us the numbers for Tehran. How bad is the stress it's leading to riots?
We're talking about catastrophic inflation. The IMF, the International Monetary Fund, estimates that current year-over-year inflation in Iran is around 50%.
50. 50.
50%. I mean, just think about what that means for a moment. If prices are rising that fast, your savings, your salary, its purchasing power is basically cut in half in just over a year and a half.
It's not just a statistic at that point. It's a social and political accelerant. I mean, I can't imagine trying to budget for your family when the price of basics, rice, bread, is just totally uncertain month to month.
Exactly. And the source confirms this level of economic suffering is the core element behind the protests. What's fascinating here is that direct link, an abstract data point high inflation and major geopolitical upheaval.
Yeah, people don't riot over a disappointing GDP report.
They riot when they can't afford to feed their families. That 50% inflation rate is the regime's #1 political liability right now.
Okay, that is immense stress. So now that we've analyzed the cause domestic hardship, geopolitical risk, let's connect this directly to what matters most for you. Portfolio strategy for 2026.
Right, moving from what is happening to what do I do?
Exactly.
The investment note is very clear. It echoes warnings that were raised earlier in the year, even before this Iran crisis, actually from that Venezuela deep dive,
And the warning is,
that geopolitical risks are expected to be substantially higher throughout 2026. This isn't a temporary spike. It's a structural change in the risk landscape.
so if the regime were to fall, or even if these protests just got much, much worse, what's the immediate market reaction we should all be anticipating?
The immediate impact would be fundamental uncertainty, which markets, they despise. Regime change would open up this huge range of possible outcomes.
Not just in Iran, but across the whole region.
Absolutely. And the most direct short-term financial fear is a disruption to those energy supplies we just talked about. If Iran's resilient output were to be halted or even just slowed,
Oil prices would spike.
predictably, pushed significantly higher. Yes.
Okay, so if the world is bracing for higher energy prices and massive uncertainty, how do we hedge? When global stability is being sold off, what are the classic safe havens?
The analysis immediately presents the classic case, holding gold in a portfolio.
The timeless asset.
It's the timeless asset for geopolitical turmoil. When central bank credibility is questioned, when currencies are volatile, when military tensions rise, gold is the ultimate store of value. It's the simplest, most efficient hedge.
All right, so beyond gold, let's talk currencies. The US dollar is usually the default, right? The undisputed king of flight to safety, especially with Middle East instability.
Usually, yes. But the analysts seem a bit hesitant this time.
More hesitant. Why?
The outlook for the US dollar is described as distinctly more nuanced than in previous crises, and that's a key takeaway for you.
So what's complicating the USD's status as a clean safe haven right now?
The source material points to its fiscal outlook being clouded by a major domestic factor,
Which is,
the looming expected ruling by the Supreme Court on the legality of the Trump administration import tariffs.
so while the world is fixated on oil flows out of the Strait of Hormuz, you're telling me we have to worry about a court ruling in Washington, D.C.
That's exactly it. That ruling introduces a huge variable for the dollar's global standing. If the court upholds the tariffs, that implies a continuation of protectionist policies, which tends to lead to a stronger but maybe more isolated dollar.
And if they strike them down?
It implies a move toward free trade, which could ease inflation but potentially weaken the dollar's immediate value. The point is, the fiscal clarity just isn't there.
The two outcomes pull the dollar in totally opposite directions.
Right. So the dollar is suffering from domestic policy uncertainty at the exact moment the world needs a clean, stable anchor.
That's a powerful insight.
It is. And in contrast to that complex, uncertain USD outlook, the note provides a very clear-cut, unequivocal recommendation.
And that is?
Further upside potential for the Swiss franc. Amid geopolitical turmoil, the Swiss franc is just the cleaner, less politically encumbered choice. Its economy is stable, its political neutrality is reliable.
And it avoids that fiscal shadow hanging over the U.S.
Precisely.
That's a critical adjustment for anyone thinking about currency exposure. Okay, let's move past commodity and currency hedges and talk about long-term portfolio structure. The analysis gets into building true resilience, moving beyond the standard 60.4 hand.
Yeah, that standard 60% equities, 40% fixed income allocation, it's been the default for decades. But the analysts argue it's just not robust enough for the kind of persistent, high uncertainty expected in 2026.
Because both sides of that portfolio can get hit at the same time.
That's the risk. When both equity markets and traditional safe haven bonds can be volatile at the same time, which, happens often during geopolitical shocks, that standard construction fails. It doesn't provide enough of a cushion.
So we need assets that, I guess, swim in a different direction.
Mm-hmm.
Things that just don't care if the S&P 500 is up or down.
Precisely. The research note continues to strongly urge complementing those traditional allocations with specific alternative assets. We are talking about incorporating assets that are explicitly uncorrelated to both equities and fixed income.
And that's the mechanism for making the whole portfolio more efficient and robust.
That's the key.
So give us some concrete examples. What do these uncorrelated assets actually look like?
The note lists several specific strategies. First, they highly recommend insurance-linked securities.
Okay, so things like catastrophic risk bonds.
Exactly. Cat bonds, they pay out based on extremely low frequency events like a massive hurricane or an earthquake. Their performance driver is meteorology, not macroeconomics.
So their returns are driven by natural disasters, which have, what, zero correlation to whether the Fed hikes rates or if the Iranian regime survives.
Zero. Exactly. Then there are infrastructure funds. They can provide stable long-term returns, often linked to inflation and supported by, essential utility operations. They're less sensitive to short-term market swings.
And then on the active management side.
Equity long-short strategies and market-neutral strategies.
So a market-neutral strategy, just to clarify, that's designed to profit from the relative movement between two stocks, like betting one telecom will outperform another, regardless of what the overall market is doing.
Correct. They aim to extract returns irrespective of the market's direction, neutralizing the big systemic risks that 60.40 portfolio is so exposed to.
So these vehicles, insurance securities, infrastructure, market-neutral funds, they're the essential defense mechanisms for the kind of world we're heading into in 2026.
It's how you prepare for a world where both equities and bonds feel risky at the same time.
This has been a really illuminating look at how domestic hardship, specifically that 50% inflation number in Iran, translates directly into concrete global portfolio strategy. To wrap this up, let's distill the 4 critical points you need to walk away with today.
Okay. First, while the protests are real and widespread, political change is not a certainty.
Right. Given the information blackout and the regime's history, we have to hedge against the potential for change, not just assume it's going to happen.
Second, the core driver of all this instability is economic stress. That devastating 50% year-over-year inflation from the IMF, that's the spark.
Third, your investment hedges. It involves the classic flight to safety, which is gold.
And the analysts' clear preference for the Swiss franc, given that the U.S. dollar's outlook is complicated by that Supreme Court ruling on tariffs.
And finally, number 4, building a truly robust portfolio means moving past that kind of inadequate 60.40 standard.
It means actively integrating uncorrelated assets, things like insurance-linked securities, infrastructure funds, and market-neutral strategies, all to enhance resilience against this high global uncertainty.
Perfect.
Now, if we can, let's leave you with a final thought to mull over, building on this deep dive.
Go for it.
If we connect this to the bigger picture, just consider the profound duality we analyzed. On one hand, Iran has massive reserves and has successfully sustained its energy output, even above the long-term average. On the other, its domestic population is suffering under 50% inflation.
So what does that duality suggest?
Well, what does it suggest about the regime's core priorities? And maybe more importantly, what level of continuous economic hardship might be necessary before material political change becomes not just speculation, but historically inevitable? That calculation is, I think, a very important consideration as you watch global events unfold.